And the third category of the assets are intangible assets. Now, the intangible assets are the financial assets without any physical substance, without any physical existence. They cannot be seen, they cannot be touched, they cannot be felt. An example of that, best example of that is a goodwill. The company's goodwill. Many times the company purchases another company by paying an additional cost above their fair value of the assets and liabilities. That is towards the goodwill, the brand which the reputation which the company has bought. So that is an intangible asset. The patent, the trademarks which the company carries on for itself, those are all a part of the intangible assets. Similar to this thing, even the liabilities are classified into two categories: current liabilities and non-current liabilities. The concept remains the same. Current liabilities are those which are expected to be settled in the ordinary course of business during the longer of 1 year from the balance sheet date or the operating cycle. The major categories of, I'm not going to go in depth to explain you now the whole concept of operating cycle. I believe you're aware of that by now. So I'll just quickly dive into the example, what kind of current liabilities are there, what kind of non-current liabilities are there, and then we'll go and look at an example on a balance sheet. Current liabilities majorly include trade payables, that is your vendors, the other payables arising from operations such as accrued wages, salaries, rental payables, royalties payable, income tax payable for the current year of operations, and so on. The unearned revenue, that is basically collection of revenue in advance from customer. This is mainly in case of subscription business model where customers pay you a 6 months of subscription in advance. There, because you have not delivered your service, the sale is not yet actually happened, you need to record it as a liability. Suppose in case you're not able to fulfill your promise, you need to return the money back. So that's a liability you're carrying on till now. But because it's due within the next 1 year, you classify as current liability. If it's more than a year or the operating cycle, you put it in the non-current liability section. Even that's one important thing to note. Now, the non-current liabilities are those which are basically, going to be, which are not current liabilities. The same concept over here. Non-current liabilities are those which are not basically current liabilities. These can include the bonds payable, bonds issued by the company, the debentures issued by the company, advance from non-current customers. Like as I said, if the advance subscription is received for 2 years, you're going to split it into two parts. Half of the part goes to the current liabilities, half goes to the non-current liabilities because that's due after the next year. With this thing in mind, I hope you have a clear understanding at least a basic understanding of what does the balance sheet look like, what are the financial statements, what is the statement of financial position going to comprise of, and so on. Now, it's not necessary for you to understand the entire balance sheet in depth. There are many more elements to cover in that if you go in that area. But it is advantageous to know the basic concept of a balance sheet because that helps you to understand how your project is going to be evaluated, how your project is going to come in the company's books of account, how at the end of the term, end of the reporting period, how is your assets and liabilities utilized by you, created by you, going to be reported in the company's books of account. Now, we'll quickly look at an example of a balance sheet and that should help you to make your concept much more clear. So this is an example on a balance sheet over here. If you see the fact over here, the asset section comprises of three things: current and non-current assets. The non-current are classified further into investment, the fixed assets, and the intangibles. That is all this area, investment, fixed assets, and intangibles, they comprise the non-current assets. Over here, the current liabilities and the rest is non-current liabilities. And another component which comes over here is the shareholders' equity. And the total of the assets is equal to your liabilities plus your stockholders' equity. So let's quickly go to the items one by one to get a quick understanding of why this item forms a part of the current or a non-current section. Okay, in the asset side, we have the cash, obviously readily realizable. Debtors due within the next 1 year or within the operating cycle. Prepaid expenses realizable within the next 1 year. That's why these all form a part of the current asset. Investment, plant expansion fund. The company has been keeping a part of the earnings aside to and has been investing in another profitable securities, and that intention is just to replace the plant. So many times it happens that the companies have purchased a plant which has useful of 10 years, but the cost to procure the plant is huge and it takes a big amount of cash flow to generate the whole amount in one shot. So companies every year for the next 10 years will put a part of the amount inside so that at the end of 10th year, when the existing plant is retired, they have readily available new plant. They have the funds available with them readily to purchase a new plant then. Then investment in marketable securities. Here the surplus cash, surplus funds are invested for generating better returns, but the intention is to hold them at least, or sell them after completion of 1 year, and so they form a part of investment. Fixed assets, land, building, machinery, all are fixed assets. And make sure you note one thing: these are reported net of depreciation. That is the actual realizable value. Intangible, as we said, that's just one example of your goodwill. Company purchased the assets or procure another company and the additional cost paid towards its net book value assets is classified as a goodwill over here. In the current liability section, we have accounts payable, salaries and wages due, income tax payable. So all these three, they are due within the next 1 year or within the next operating cycle. Hence, they form part of current liability. In the non-current liabilities, we have the long-term bonds, the debentures issued. That is all due after a period of 1 year. Lastly, we have the shareholders' equity, that is a capital stock, retained earnings, and so on. That gives you the total stockholders' liabilities and stockholders' equity. Before we proceed to the next part, there's one important note which I wanted to make. A balance sheet is always prepared at the corporate level, so it is difficult to break it down to individual project level. So the point is that it's literally not feasible enough. It is possible, but it's not feasible enough to prepare the balance sheet at a individual project wise. And the main reason over here, if you notice that in the liability section we have this long-term bonds. Now these bonds can be issued to raise a capital which is accessible for every project the company has undertaken, as well as for the common activities for the organization also. Let's say a part of the bond is utilized for procuring a new office, expansion of the office where every employee sits, okay, for bringing every employee to the centralized location. So in that case, it's difficult to allocate the part of the bond to the projects over here. So that's why balance sheet is always prepared at the organization level, not at the individual project levels. Okay. With this thing, we complete our concept on balance sheet. In the next session, we're going to start with the income statements.